You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. We have a fascinating setup today where Wall Street is pushing higher, yet the underlying mood feels incredibly fragile ahead of the Federal Reserve decision.
It really does.
The central conflict right now is a sliding U.S. dollar following some volatile comments from President Trump, all while gold has absolutely smashed through historic records.
And that disconnect is really the story of the day.
We're also looking at a complex web of trade tensions, from Chinese EVs entering via Canada to friction with South Korea over tech regulation. Let's get into it.
It is certainly a busy morning, and what stands out immediately is this massive disconnect you just mentioned. You have equities holding up, acting like we're in a perfect soft landing scenario, but underneath, the currency markets are telling a story of extreme nervousness.
Okay, let's unpack this, because nervousness feels like an understatement when you look at the currency board today.
I agree with that.
I mean, usually, when the U.S. stock market is rallying, the S&P 500 is looking strong, you expect the dollar to act as a magnet for global capital. Strong economy, strong currency.
Right, that's the textbook case.
But right now, we are seeing the opposite. The dollar is struggling. What is breaking that correlation?
It's a combination of policy noise and market positioning, but the catalyst that really upset the apple cart happened late Tuesday.
What was that?
President Trump signaled that he is comfortable with the dollar moving, as he put it, like a yo-yo.
Like a yo-yo.
Mm-hmm.
I have to be honest, when I saw that quote, I winced a little. Stability is usually the #1 selling point of the world's reserve currency.
It's the only selling point, really.
If I'm a foreign central bank or a multinational corporation, I need to know what the dollar is going to be worth in 6 months. A yo-yo sounds like a nightmare for long-term planning.
That is exactly right. For decades, the implicit policy of the United States Treasury has been to support a stable dollar. It's the bedrock of the global financial system. So when the president effectively reintroduces FX policy rhetoric as a risk factor, saying it can go up or down and he's fine with it, that just adds a layer of uncertainty that traders absolutely hate. It essentially adds a risk premium to holding the dollar.
So the president is saying, let it swing. And the market's saying, okay, if you don't care about stability, we're selling.
That's the short version, yes.
But we also have the Federal Reserve meeting right in front of us. The consensus is that they're going to pause rates. That's priced in. So why is the market so jittery? If we know the destination, why the turbulence?
Because while the pause is priced in, the future is not. The real risk lies in Chair Powell's tone.
His tone, okay.
His tone regarding future easing. The market is desperate to know. Is easing being pulled forward? Is he going to signal cuts sooner rather than later? Or is he going to keep it at arm's length?
And this connects back to the dollar weakness, doesn't it? If the dollar is already sliding because of the yo-yo comment, and then Powell comes out sounding dovish, too eager to support the economy, he could accidentally push the currency off a cliff.
Exactly. It puts the Federal Reserve in a very tight box. They don't want to crash the currency, but they might need to support the bond market. And while the dollar is stumbling, we have to look at what is taking its place. The euro briefly reclaimed the 120 level.
But let's be real here. Is that because the European economy is suddenly booming? I haven't seen any data out of Germany or France that suggests a miraculous turnaround.
No, you're right to be skeptical. The euro is rising largely by default. It's moving up because the dollar is moving down.
So it's a relative trade.
100%.
Yeah.
The European Central Bank commentary hasn't really disrupted the move, but they certainly aren't driving it with hawkish policy. It's the same story with sterling. It pushed to multi-year highs but failed to hold above 138.
Right.
There just isn't enough positive news flow out of the UK economy to sustain a breakout on its own merits. It's a reflection of US weakness, not British strength.
Okay, so the euro and sterling are just passengers on the dollar's ride. But the yen, that feels different. We saw the yen rebound from a 3-month low against the dollar. This feels like a tug of war between economics and politics.
It is the ultimate tug of war. On one side, you have the fundamental reality. Interest rates in the U.S. are still much higher than in Japan.
The rate differential.
Exactly. Money naturally flows to where it gets paid the most interest, which means selling yen to buy dollars. That's the economic gravity.
But then you have the political hammer.
Precisely. Trump has accused Japan and China of wanting weaker currencies to cheat on trade. So the market hears that and thinks, okay, the Japanese Ministry of Finance might be forced to intervene.
Just to avoid getting on the wrong side of the U.S.
Just to strengthen the yen to avoid U.S. tariffs. So you have traders selling the yen for the yield, but terrified to be short the yen because of the political risk. It creates this volatile, choppy mess where nobody wants to take a long-term position.
It sounds like a headache for anyone trying to trade that pair. And speaking of headaches, let's pivot to trade. It feels like we're playing a game of whack-a-mole lately. Every time we look, there's a new tariff or a new restriction, especially with Asian partners.
It's definitely more complex than just, we are taxing your steel.
Yeah.
It really is widening beyond just simple tariffs. It's moving into supply chains, digital services, and corporate governance. Look at South Korea. This is a crucial military and economic alliance for the U.S., yet we are seeing a very specific kind of friction.
Okay.
On one hand, you have President Trump striking a diplomatic tone, saying the U.S. and South Korea will find a solution together. That's the carrot.
And the stick is the tech sector.
The stick is the administration warning Seoul not to target U.S. tech firms with discriminatory investigations. There are reports that these discussions are specifically circling interactions regarding Coupang, the e-commerce giant.
So the message is, we can be friends, we can have a trade deal, but don't you dare use your antitrust laws to hobble our tech companies.
Exactly. It's an assertion of digital sovereignty. Our companies operate by our rules. And we are seeing a similar tightening of the screws with Canada, specifically regarding Chinese electric vehicles.
I saw this headline from the United States Trade Representative. They are signaling that the U.S. intends to block Chinese EVs entering through Canada.
And this is significant because it targets the supply chain routing. Usually, trade policy focuses on where a product is shipped from.
Right, the country of origin.
But here, the U.S. is saying, we don't care if you ship it to Vancouver first. We don't care if it comes in on a Canadian truck. If it's a Chinese EV, the border is closed.
That closes a massive loophole. It basically kills the idea of using the U.S.-Mexico-Canada agreement as a backdoor.
It completely kills it. If you're a Chinese manufacturer, you can't just set up a warehouse just across the border and drive the cars south. It forces a complete rethink of global logistics for these companies.
And while we're talking about tariffs, I notice India is also still in the mix. The U.S. is maintaining that 50% tariff rate on Indian goods.
Yes, the 50% rate remains.
But I noticed a very interesting detail in the readout. The U.S. explicitly noted that India has made progress in reducing its reliance on Russian oil. That felt like a very strategic pat on the head.
It is geopolitical poker. We'll keep the tariffs, but we acknowledge you're aligning with us on energy security. It shows that trade policy isn't just about economics anymore. It's a tool for foreign policy compliance.
Right.
But, and here is the aha moment in all this gloom.
Okay.
Despite the tariffs, despite the rhetoric, Beijing has reportedly approved imports of over 400,000 NVIDIA H200 chips.
Wait, 400,000? That's a massive order. I thought we were in the middle of a chip war where we were cutting them off from high-end compute.
We are, in theory, but this suggests that, cross-border policy calibration is happening even amidst the tensions. It's a signal of selective reopening.
But China needs the chips.
They need the compute power for AI development. They can't afford to fall behind. And U.S. companies, frankly, want the revenue from selling those chips.
So it's pragmatism winning out over ideology. When the money is big enough or the strategic need is high enough, the borders open up.
Exactly. It shows that underneath the blunt force of tariffs, there is still a pragmatic flow of high-tech goods when it suits both sides.
Well, if the trade market is complex, the commodities market seems to be screaming one word: scarcity. I was looking at the charts this morning and, well, I definitely leaned in closer. Gold broke above $5,200 an ounce.
$5,200 per ounce, a fresh record high.
Okay, we need to strip this down. Is this just fear? Is everyone buying gold because they think the world is ending? Or is this structural?
It's what we call classic late cycle behavior. Think about the position of the average institutional investor right now.
Okay.
They are still holding risk assets like stocks. The S&P 500 is high, and they don't want to miss out on those gains, but they are incredibly nervous about the debt, the yo-yo dollar, and the Fed.
So they aren't selling their stocks, but they are buying a massive insurance policy.
Exactly. They are willing to pay a premium for protection. They are buying gold not because they are bearish on growth, but because they are bearish on the currency.
On the dollar itself.
If the dollar is going to be volatile, gold becomes the ultimate store of value. It's the hedge.
So it's, I'll stay at the party, but I'm wearing a life jacket under my tuxedo just in case the ship hits an iceberg.
That is a perfect analogy. And it's not just gold. Oil is remaining incredibly elevated, but for very different reasons. We aren't seeing new demand catalysts.
No, the economy isn't booming that hard.
But we are seeing massive supply shocks.
This is the weather issue in the U.S., right?
Yeah.
I read that production took a massive hit.
Yes. A massive winter storm in the U.S. has cut national production significantly. Estimates suggest up to 15% of national output was lost over the weekend.
15%. That is a huge amount of supply to vanish overnight. That creates bottlenecks at refineries, pipeline issues. It's a logistical nightmare.
It is, and it explains why the price is spiking even if demand is flat. And you can see how desperate the situation is becoming because there are reports the U.S. may issue a general license lifting some sanctions on Venezuela's oil industry.
We're going back to Venezuela. That feels like a move of last resort.
It is a headline to watch. Now, we have to be realistic. Venezuelan infrastructure is degraded. They can't just turn a valve and flood the market with oil tomorrow.
Of course not.
But the fact that the U.S. is even considering it shows they're looking for barrels anywhere they can find them to keep prices down.
It's amazing how weather and geopolitics collide at the pump. But speaking of supply shortages, I saw that copper is rallying near $6 a pound.
Right.
But what really caught my eye wasn't the price, it was who is buying. The news about Citadel.
This is a key institutional signal. Bloomberg is reporting that Citadel, one of the biggest, most sophisticated hedge funds in the world, is moving into industrial metals.
Why is that significant? Don't hedge funds trade everything?
They do, but the reports suggest they are moving into physical or near-physical industrial metals markets as prices hit record highs.
So this isn't just a paper trade.
For a firm like Citadel to shift its stance and enter the physical market now signals that the smart money believes the structural supply shortage is real.
They aren't just trading a chart blip. They are betting that there literally isn't enough copper and tin to build the green energy transition, the data centers, and the EVs.
Exactly. They are positioning for a world where raw materials are fundamentally scarce. And that feeds back into the Federal Reserve's problem.
How so?
How do you cut rates and declare victory on inflation if the price of copper, which is in everything, is skyrocketing?
You can't. If the inputs are expensive, the outputs are expensive. Which brings us to the background noise that never seems to go away. Geopolitics.
Always there.
We've got the Middle East, Ukraine, North Korea. It feels like a lot of simmering pots. What is actually moving the needle?
The Middle East remains the primary pressure point for risk premiums. Israeli Prime Minister Netanyahu issued a warning that if Iran attacks, Israel would respond with unprecedented force.
Unprecedented force. That is not ambiguous language.
No. And we also saw reports of a suspected infiltration from Jordan. Plus, the Islamic Revolutionary Guard Corps threatened to treat neighboring states as hostile if their territory is used as a launch point for attacks.
Wow.
That is the kind of language that keeps oil traders up at night because it threatens to widen the conflict zone to the entire Gulf.
It's not just two countries anymore. It's the whole neighborhood. And then we have Iraq. President Trump had some strong words there, too.
He did. He warned that Iraq would make a very bad choice by reinstalling Nouri al-Maliki as prime minister.
And he threatened to do what?
He threatened to withdraw U.S. help entirely. This shows that U.S. foreign policy messaging is becoming increasingly direct. There's no diplomatic sugarcoating. It's do this or you're on your own.
And markets have to price in the volatility that comes with that kind of brinkmanship. If the U.S. pulls out of Iraq, that creates a vacuum.
And vacuums in the Middle East are usually filled by chaos.
Correct. And briefly on Ukraine, Russia, Trump said very good things are happening, but it's extremely vague.
Right. Just talk for now.
It contrasts sharply with the lack of concrete diplomatic pivots. Markets are alert to it, but until we see a signed paper, it's just talk.
So we have a nervous Fed, a volatile dollar, trade wars, expensive commodities, and geopolitical threats. Yet, looking at the screen, the S&P 500 closed higher. What is the outlook here? Are we missing something?
Well, the equity market is being driven by mega-cap strength. It's constructive, but it is fragile. It is entirely dependent on policy outcomes, specifically Powell, the Bank of Canada, and Brazil staying benign.
Okay.
But before we wrap up, there was a surprise in the Asia-Pacific region that many people missed while watching the Fed.
Oh, what's happening down under?
The Australian dollar. There has
Yeah.
been a significant shift in expectations for the Reserve Bank of Australia. I thought the global trend was cutting rates, or at least pausing, like the U.S.
That's the consensus, but ANZ Bank has changed its call. They are now predicting the Reserve Bank of Australia will execute a 25 basis point hike next week.
A hike next week. That seems incredibly countercyclical. Why would they hike when the rest of the world is talking about cuts?
They describe it as an insurance move because domestic inflation is proving stickier than expected. But think about what that does.
What's the implication?
It puts Australia back into the global tightening conversation.
It disrupts the narrative. If a major G20 economy is hiking, maybe inflation isn't as dead as we thought.
Exactly. Even though the Aussie dollar lost some momentum recently, this expectation of a hike could change the global capital flows significantly. It highlights that inflation isn't beaten everywhere.
Right.
And for you, the listener, that's the key takeaway today. We have a constructive market, but the risks from the yo-yo dollar to the potential Reserve Bank of Australia hike are all idiosyncratic. They are popping up where you least expect them.
So keep your eye on the Federal Reserve, but don't ignore the supply chains or the Aussie Central Bank. It's all connected.
Precisely. If we connect this to the bigger picture, we are in a market that is pricing in perfection stocks at highs, while the physical world of commodities, war, and trade is getting messier. Something eventually has to give.
That is a sobering thought to end on. The disconnect between the ticker tape and the real world. Appreciate you tuning in. Join us again on the Financial Source Podcast.